Welcome to ACCA Academy tutorial on relevant costing in discounted cash flows analysis. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, thank you for being part of this channel. So the word discounting means the calculation of present value. Discounting means present value. Discounting, it means present value. So if you discount your cash flows, it means you calculate the present value of those cash flows. So the essence of discounting is to account for the time value of money, because what a dollar can acquire currently, that same dollar may not acquire it a year after. So in order to account for the time value of money, that is why the cash flows needs to be discounted. And we have two types of cash flows. We have two types of cash flows we want to examine. We have the cash inflows, and the cash outflows. It means you can calculate the present value of the cash inflows. You may equally calculate the present value of the cash outflows. So if you now subtract the present value of cash inflows, present value of cash inflows minus present value of cash outflows, the result obtained is called net present value. Net present value. It means net present value is the difference between the present value of the cash inflows and the present value of the cash outflows. I've examined the calculation of net present value in my earlier video. I will deepen into the calculation of net present value after I've explained the relevant costing in discounted cash flows analysis. So the net present value, I told you, I said it's the difference between the present value of the cash inflows and the present value of the cash outflows. That is net present value. So, and on the other hand, we have the internal rates of returns. And internal rates of returns, PV of cash inflows minus PV of cash outflows. If it is equal to 0, it gives you the internal rates of returns. That means the internal rates of returns, internal rate of returns, IRR, is the rate of returns that equates the net present value to 0. Net present value to 0. The rate of returns that equates the net present value to 0, that rate is known as the internal rate of returns. So it means the rate of returns that equates if the net present value equal to 0. That means if PV of cash inflows minus PV of cash outflows equal to 0, then PV of cash inflow equal to PV of cash outflows. So the rate of returns that equates the PV of cash inflows to the PV of cash outflows, that rate of returns is known as the internal rate of returns. But my focus in this lecture is relevant costing in discounted cash flows analysis. What is a relevant cost? Relevant cost is a differential future cash flows that arise in direct consequences of decision. Relevant cost is a differential future cash flows that arise in direct consequences of decision. A differential future cash flows that arises in direct consequences of decision. From this definition, we can see the following features of relevant cost. Number one, we have differential. Differential. The word differential means changes. So that means relevant costs are changes costs. Costs that change. That is, they are not generally fixed. So if you want to make decision with them, as a result of the decision you are about to make, those costs will change. They will increase with the decision you want to make. That is differential. Then we also have future. Future costs. It means all relevant costs are future costs. Costs that have been incurred before the commencement of the project are not relevant. It means past costs are not relevant. So, cost of conducting a research. Research costs. Research has been undertaken before the project is launched. So, the past costs are not relevant. So, they are futuristic. And the top feature I will examine is cash flows. All relevant costs are cash flows. They are cash flows. That means non-cash items are not relevant. Examples of non-cash items you may see in the financial statement might include the profit from disposal of an asset, or loss from disposal of an asset, amortization, impairment, provisions, depreciation, etc. Anything that is not a cash flows are not relevant. All relevant costs are cash flows. Number 4 feature we may equally see in that definition is direct consequences of decision. Direct consequence. Decision. It means they must be incurred solely for the project or in the project you want to undertake. It means these are costs that must be incurred anytime you want to make an alternative decision. If that decision about undertaking that project, if it's not to be made, those costs will not be incurred. It means if you want to decide whether to undertake the project, those costs must be incurred as a result of the project you want to undertake. These are some of the features of relevant costs. I want to examine the various concepts of relevant costing. Concepts of relevant cost. Number 1 concept I will examine is sunk costs. Sunk costs. Sunk costs are past costs. Costs incurred before the project is launched. Costs incurred before the commencement of the project. They are sunk. I've told you relevant costs are future costs. They must be futuristic in nature. Past costs are not relevant. Not relevant. Not relevant. So, number 2 concept is the timing of cash flows. Timing of cash flows. By timing of cash flows, we mean the time the cash flows are incurred. The time of incurring the cash flows. Some of the cash flows may be incurred in the beginning of the year. Beginning, and while some may be incurred at the year end. If cash flows are incurred at the beginning of the year, you use them in the immediate preceding year. For instance, cash flow incurred at the beginning of year 1, so you use it in year 0. And the one incurred at the beginning of the year 2, you use it in year 1. The one incurred at the beginning of the year 3, you use it in year 2. That is for the one incurred or the one occurring at the beginning of the year. But if the cash flows occurs at the year end, you use them in the same year. If the cash flows occurs at the year end, those cash flows must be used in the same year they were incurred. If they occur at the end of year one, you use them in that same year, year one. If it occurs at the end of year two, you use it in the same year two. That is timing of cash flows. Then the third concept of relevant costs I want to examine is materials. Materials. Materials are the substances from which goods are manufactured. The substances from which goods are produced, that is materials. For our purpose, we will categorize the cost of materials into two. Some of the materials will be bought specifically for the project. Those materials that are bought specifically for the project, I will refer to that as bought-in materials. Bought-in materials are the materials that are bought specifically for the project. It means if that project is not to be undertaken, this material wouldn't have been bought. These materials will not be bought if the project is not to be undertaken. So, but if you want to make decision about undertaking that project, then you will need those materials. Then that means you have to buy them. So the cost of purchasing these materials were incurred, indirect consequences of the project. These materials were bought specifically for the project, so their cost arises as a result of they arises in direct consequences of the project. Therefore, bought-in material is always a relevant cost. Relevant cost. Then the second materials are existing materials. Existing materials are materials that are held as stock in trade, or materials that are held in inventories. That is existing. The entity have them already in stock. They are not just purchasing them. It's maybe they have undergone a project in the past, and some materials were bought for that project. The whole of the materials bought for the project were not used up in that project. So the remaining one were not kept in their warehouse. That is existing. So the costs at the time of purchase of this material have sometimes been incurred in the past. Since that cost have been incurred in the past, it is therefore a sunk cost. And I've told you that sunk costs are not relevant. So now, in determining the relevant cost of an existing material, so we will look at it in two angles. Number one, we have regular use material. Regular use materials. And number two, we have not used regularly. Now, for a material that, for the materials that are used regularly, it means the moment the one you have in inventory are exhausted, you will have to buy another one. Where the materials that are used regularly for the project are exhausted, then the entity will still need another quantity of that material. That means another one will need to be bought because they will still need it in subsequent project. If they want to buy that material, the material will already be bought at their current replacement price. Therefore, where it can be ascertained that the materials are used regularly, the replacement price of that material, replacement price is their relevant cost. So, where materials are used regularly, you use their current replacement price as their relevant cost. By replacement price, we mean the current market value of the materials. The current market value. It means if you want to buy them currently, how much would they be bought? The price at which they will be bought currently is not the replacement price, which is the current market value of the materials. And I've told you this price, the replacement price, the market value, the current market value, I say it's a relevant cost where it can be ascertained that the materials are used regularly. Now, the second one that we examine is where the materials are not used regularly. It means if they are not used regularly, the entity may have the option of disposing them off if they don't need them again, where they can get people willing to buy them. So, where the materials are not used regularly, the relevant cost of those type of materials, if the materials are not used regularly, their relevant cost is the higher of these two prices. Where materials are not used regularly, disposal value. That is, if you want to sell them, the amount you can sell them, or the net realizable value. Disposal value or net realizable value. That is, if you want to sell that existing material, the amount you can sell them, that is the disposal value. The higher of the disposal value, the higher of the price you can sell them, or lost contribution from alternative use of the material. Lost contribution from alternative use of the materials. The amount of contribution that will be lost from alternative use of the material. Lost contribution from alternative use of the material. The higher of this, higher of the disposal value, higher of the net realizable value, higher of the scrap value, any of this, higher of the disposal value, or higher of net realizable value, or higher of the scrap value, or lost contribution from alternative use of the materials. Whichever one is higher is the relevant cost. Example 1, unrelevant costs of materials. A company is considering a project expected to last for 3 years, which will require the use of 3 different materials with details below. A. Material A. 20,000 kg of material A is required for the project annually, and there is none in inventory. The replacement price of the material is 420 kobo per kg. B. Material B. The project requires 15,000 kg of material B annually. Material B is used regularly, and the company always keeps 5,000 kg of material as buffer stock annually. The material costs 3 naira per kg when it was purchased, but the price has now risen to 3 naira 50 kobo per kg. C. Material C. Material C has no other use in the company, and there are currently 12,000 liters in stocks, which cost 144,000 naira. The project requires 17,000 liters annually. The available material C can be sold for 96,000 naira, if not for use for the project. Material C can be replaced annually at 15 naira per liter required. What is the relevant cost of material A, B, and C for the 3 years of the project? Solution. You were told a company is considering a project expected to last for 3 years, which will require the use of 3 different materials with details below. We have material A. So 3 different materials are required. So we have materials, or let me have years. The life of the project is 3 years. Year 3, year 2, and year 1. These are the 3 years of the project life. So we have materials. Now, you were told material A, 20,000 kg of material A is required for the project. Material A required. Let me say requirement. In year 1, 20,000 is required. In year 2, 20,000 is required. That is why the question say 20,000 kg of material A is required for the project annually. That is, in each of the years, what you need for production is 20,000 kg. Now, and there is none in inventory. Since material A is not available, so you don't have them in inventory. So I've told you where material is not available. That is, if the entity are in need of such a material, they will have to buy them. So that means material A is a bought-in material. I've told you that the replacement price, the current market price of a bought-in materials is the relevant cost of that material. So now, how much will it be bought? The replacement price of the material is 420 kobo per kg. So since 20,000 kg is required annually, 20,000 kg is required at the cost of 4 naira 20 kobo. 4 naira 20 kobo. Each year, how much will be the cost of material A? Remember, material A is a bought-in material. Bought-in. And I've told you the replacement price, that is the current market price of a bought-in material is the relevant cost of that material. By bought-in, it means the materials that will be specifically purchased for the project. So this costs 84,000 naira. Since the entity did not have them in stock, it means when the entity needs them, they will have to buy them for the project. That is why we refer to that as a bought-in materials. So material A. So the relevant cost of material A in year 1 will be 84,000 naira. In year 2, you have to buy another material A worth of 84,000 naira. In year 3, another material A worth of 84 naira will be required. So that is for material A. Now, material B. So what type of material is material B? So you were told the project requires 15,000 kg of material B annually. What you need annually for production is 15,000 kg. Material B is used regularly. Remember, I've told you where it can be ascertained that the materials are used regularly. Then that means the relevant cost of the material is the current replacement price. And the company always keeps 5,000 kg of materials as buffer stock annually. By buffer stock, another word for buffer stock is safety stock level or minimum stock level. The levels at which the entity must not allow its inventory to fall. So what the entity must always keep in inventory is 5,000 each year. So that means 5,000 were in stock. So now the material cost 3 naira per kg when it was purchased. It has been bought. The 5,000 have been bought in the past. So that is a sunk cost. I've told you that the sunk cost or past costs are not relevant. Therefore, this 3 naira is not relevant when it was purchased. But the price has now risen to 3 naira 50 per kg. If you want to buy anyone now, the current replacement price, that is the market price of the material, is 3 naira 50 kobo. So anyone you want, any quantity you want to purchase currently now will be bought for 3 naira 50 kobo. So material B now, material B. So you have existing. You already have, in year 1, you have 5,000 in stock. That is existing materials. So, but these 5,000 you have in stock in year 1 will be used. And that means you'll be having none in stocks in the subsequent period. So, bought in now. The rest of the material, the rest of the materials required will be bought. You have been told that 15,000 kg of material B are required. Since 15,000 kg are required, and in year 1, you already have 5,000 in stock before. That means additional 10,000 will be bought. you will buy another 10,000 to make it 15,000. But in year 2, none is left in stock. You will buy the whole of the 15,000 kg required. So these are in kg. In year 3 again, none is in stock. You will buy the 15,000 kg required. Now, you have been told that material B is required, is used regularly. And I've told you where it is used regularly that the current replacement price is the relevant cost. So that means the replacement price, which is 3.50 kobo. So that will be the relevant cost of material B. So now, relevant cost now. Relevant cost. Existing material, the existing one, which is 5,000 here, times the replacement price, which is 3.50 kobo. So that will cost 5,000 times 3.5. That gives us 17,500 for the existing. But in year 2, no existing material B. In year 3, no existing. But bought in materials now. Bought in year 1. Year 1, you will buy 10,000. 10,000 at 3.50 kobo. 10,000 will be bought in year 1 at 3.50 kobo, the current replacement price. That will give us 35,000. But in year 2, year 2 and 3. So what you need is 15,000. That means the whole of the 15,000 you need in year 2 and 3 will be bought. So we have 15,000 at what price? 3.50 kobo. In year 2 and 3, 15,000 times 3.5. 15,000 times 3.5. That gives us 52,500. 52,500 in year 2. In year 3, 52,500. So what will be the relevant cost of material B? In year 1, 17,500 plus 35,000. That is 52,500. In year 2, 52,500. In year 3, 52,500. So the relevant cost of material B is 52,500 in each of the years. So we have 52,500. So material B, year 1, 52,500. In year 2, 52,500. In year 3, 52,500. 52,500. So in each of the years. C, material C. Material C has no other use in the company. And there are currently 12,000 liters in stock. It has no other use. And I've told you where materials are not used regularly. The relevant cost will be the higher of the net realizable value or the loss contribution from alternative use of the material. Higher of the net realizable value or lost contribution from alternative use of the materials. Now, since the material has no alternative use, 12,000 are in stock. So 12,000 are existing materials. That means, and you were told in stock which costs 144,000. This 144,000 is a sunk cost, a past cost. And I've told you that past costs are not relevant. The project requires 17,000. So it means if the project requires 17,000, you already have 12,000 in stock. That 12,000 you have in stock will be used in year 1. Then that means you will need to buy additional 5,000 in year 1. But in year 2, none is left in stock. Then that means you will buy 17,000. So also is year 3, liters annually. The available material C can be sold for 96,000. I've told you where the materials are not being used regularly, I've told you that the relevant cost is the higher of net realizable value or the disposal value and the loss contribution from alternative use of the material. If not for use for the project, material C can be replaced annually at 15 naira per litre. So this is the current replacement price, which is the current market price. So for material C now, material C, so we have existing material C. So you already have 12,000 in stocks. So that means in year one, the 12,000 you have will be used in year one. Liters, year 1, 2, and 3. So, and what you need annually is 17,000 liters annually. You need 17,000 liters every year. So that means you will have a bought-in material C. Bought in, that means you will buy additional 5,000 in year 1 to make it 17,000 required for production. In year 2, since none is left in inventory, the whole of the 17,000 liters you need will be bought. In year 3, 17,000 liters you need for production will be bought. Now, what will be the relevant cost of material C? Relevant cost for the existing material C, since it is not used regularly, it has no other use. So that means it is not used regularly. It has no other use in the company. So I've told you where it has no other use. I said the relevant cost will be the higher of net realizable value and lost contribution from alternative use of material. Therefore, you are only given, you were told the available material C can be sold for 96,000. That is the realizable value. That is what you are given for material C. So in that case, there is no loss contribution. So that means the amount you can get from the sales of material C will be the relevant cost of that existing one. That means the relevant cost of the 12,000 you have in stock. So that is 96,000. Then the rest will be bought in. So year 1, you will buy 5,000. At what price? The current replacement price, which is 15 naira. So we have times 15. 5,000 times 15, that gives us 75,000. In year 2 and 3, what is required for production is 17,000. That means the whole of the 17,000 required for production in year 2 and 3 will have to be bought. So we have to buy 17,000. That means that one is bought in materials. Bought in. So at the current replacement price, which is 15 naira. So 17,000 times 15. That gives us 255,000. 255,000 in year 2. 255,000 in year 3. So if you sum up this, 96,000 plus 75,000, this is totaled 171,000. So the material C required in year 1 is 171,000. In year 2, we have 255,000. In year 3, 255,000. That is the relevant cost of material C. So year 1, 171,000. Year 2, 255,000. Year 3, 255,000. So that is the relevant cost of material C. Number 4, we have relevant costs of equipment. Equipment or plant and equipment. Equipment are assets used in production or assets used outside. For our purpose, we will have the bought-in equipment. Bought-in equipment, that means they are equipment that are specifically bought for the project. Equipment that are bought specifically for the project. So the amount at which these assets were acquired, since they were acquired at the sanction of the project, it means the cost of those equipment will be treated as an outflows in year 0. You treat that as an outflow in year 0, while their scrap value will be treated as an inflow at the end of the project life. But the second class of equipment I will examine is existing equipment. The equipment the entity already had. So they are not just acquiring them. They have them before. So that is existing equipment. So the relevant cost of existing equipment will be higher of number 1, we have the disposal value. Higher of their disposal value. Higher of the disposal value of the equipment or present value of cash flows that could be earned by having alternative use of the equipment. Present value of cash flows present value of cash flow that could be earned that could be earned by having alternative use of the equipment. Alternative use of the equipment. I told you the higher of the disposal value of the equipment or the present value of cash flows that could be earned by having alternative use of the equipment. This will be the relevant cost of the existing equipment, the higher of the two. Example 2, relevant cost of equipment. A company is considering a project which is expected to last for 3 years. The project will require 3 of the company's existing equipment with details below. A. An assembly plant owned by the company with a current disposal value of 550,000 naira, if not used for the project. The assembly plant could be used on another project that will generate future cash flows with a present value of 485,000 naira. B. A molding machine will be required for the project. The molding machine can also be used for an alternative project with present value of its future cash flows of 380,000 naira. The current disposal value of the machine in year 3 is 300,000 naira. C. The company has a delivering truck which is no longer used for regular work and can be sold now for 255,000 naira. An opportunity has arisen to use the truck for this project. The disposal value of the truck at the end of the project is, if used for this project, will be 185,000 naira after spending 25,000 naira on repairs to get it into conditions for sale. Required. Calculate the relevant cost of the 3 equipment used for the project. A company is considering a project which is expected to last for 3 years. The project will require 3 of the company's existing equipment with details below. A. An assembly plant owned by the company. You know, the project have 3 years. So we have years, year 3, year 2, and year 1. The first one is assembly plant. Assembly plant. An assembly plant owned by the company. This is an existing plant and equipment since it is owned by the company. Besides, at the beginning of the question, company's existing equipment. So you were told all these equipment were owned by the company. So there is no bought-in. I've told you where you have a bought-in equipment, the relevant cost is the current purchase cost of that bought-in equipment. So this is an existing one owned by the company with a current disposal value of 550,000. If you want to sell that equipment now, so it will be sold for 550,000 naira if not used for the project. So it is, if you don't want to use it for the project, you will sell it for 550,000. That means the opportunity cost of you using the equipment assembly plant in the project is the 550,000 you will forgo from selling it. Because if you want to use it in the project, you will not be able to sell it. And this becomes the opportunity cost of using that plant in the project. And I've told you that the opportunity cost is always a relevant cost in decision making. So 550,000, if not used for the project. The assembly plant could be used on another project that will generate future cash flows with a present value of 485,000. If it is not used for the project, so there is an alternative use of that plant again, elsewhere, that will generate the present value of future cash flows of 485,000. And I've told you that the relevant cost of existing equipment is the higher of the disposal value of the equipment or present value of cash flows that could be earned by having an alternative use of the equipment. So the higher of these two, the higher is the relevant cost, and 550,000 is the higher. So the relevant cost of the assembly plant is 550,000. So we have year 0 as well, and that will be treated as an outflows in year 0. So existing assembly plant, the relevant cost is 550,000. That will be treated as an outflows in year 0. So no other cost pertaining to assembly plant will be relevant. B. A molding machine will be required for the project. The molding machine can also be used for an alternative project with present value of its future cash flows as 380,000. The present value of future cash flows from alternative use of the molding machine is 380,000. The current disposal value of the machine in year 3 is 300,000. The disposal value is 300,000. So now you want to use the machine in the project. I've told you the relevant cost will be the higher of the current disposal value or present value of future cash flows. Present value that could be earned by having alternative use of the project. The higher is 380,000. Therefore, the relevant cost will be 380,000. That is for the molding machine. So we have molding machine. The relevant cost of the molding machine is 380,000. That will be treated as an outflow in year 0. So see, the company has a delivery truck which is no longer used for the regular work and can be sold now for 255,000 naira. This delivery truck has the current disposal value of 255,000. An opportunity has arisen to use the truck for this project. The disposal value of the truck at the end of the project, if used for this project, will be 185,000 after spending 25,000 on repairs to get it into condition for sale. You know, this is the disposal value now. And this disposal value of 255,000 now that occurs now will be treated as an outflows in year 0. But at the end of the project, you have the net realizable value to be 185,000 minus 25,000, which will give us 160,000. That will be treated as an inflows at the end of the project life. The disposal value now, you were told it could be sold now. When you have now, currently, now, that will be treated, any information that is about now, that will be treated, that will be used in year 0 in capital expenditure decision. So you have this in year 0. But at the end of the project life, that is when you have the net realizable value to be 160,000, which is the disposal value of 185,000 minus 25,000. That is for delivery truck. So we have delivery truck, 255,000 as an outflows in year 0. Then the net realizable value of the delivery truck will be 185,000 minus 25,000. Then you have 160,000. And this 160,000 will be used as an inflow at the end of the project life, which is year 3. So you have 160,000 treated as an inflows. Number 5, we have relevant cost of working capital. Relevant costs of working capital. So working capital should be treated as an outflows. Working capital outflows in year 0. In year 0. And be recovered. Year 0. And be recovered in full at the end of the project life. Then and be treated as an inflows. Then that means that same working capital will be treated as an inflow at the end of the project life. You have the working capital treated as an outflows in year 0. Then at the end of the project life, you will have the same working capital treated as an inflows. But where it is incremental in nature, where it increases over the year. So the amount you have at the inception of the period, you treat it as an outflows in year 0. Then you look at the amount of increment or a decrease between the period, between the years. So between year 1 and 2, for instance, if it increases by 20,000, then the 20,000 will be treated as an additional working capital in year 1. Between year 2 and 3, if it increases by 30,000, the increment of 30,000 again will be treated as an outflows in year 2. So then the whole of the working capital you have will be treated as an inflow at the end of the project life. And where it decreases, the amount of decrease in working capital, you treat it as an inflows in between the year of decrease. So, and the working capital you have will now be treated as an inflow at the end of the project life. Example 3, relevant cost of investments in working capital. A company is considering whether to invest in the production of a new product. The project will have a 6-year life. Investment in working capital will be 30,000 naira at the beginning of year 1 and a further 20,000 at the beginning of year 2. What is the relevant cost of the working capital? I've told you that working capital will be treated as an outflows in year 0, and at the end of the project life, the whole amount of working capital will be recovered and then be treated as an inflows. It means the working capital that you initially have as an outflows, the total of everything will still be reported as an inflows at the end of the project life. And now it occurs in year 1 and 2. Remember, we have a timing of cash flows. We say cash flow that occurs at the beginning of the year will be treated in the immediate preceding year. So it means any cash flow that occurs since at the beginning of the year, you treat it in the year before that very year. So beginning of year 1, that means you have that in year 0. The one at the beginning of year 2, you have that in year 1. So that is how that will be treated, because the cash flows, the working capital occurs at the beginning of the year. And if the time the working capital occurs, if it is not given in the question, so you treat it as an outflow in year zero. Then at the end of the project life, you recover the whole amount and then be treated as an inflow. So we have years. 6 years are involved. Year 6, year 5, year 4, year 3, year 2, year 1, then we have year 0. Year 0. So these are the years involved. So we said investment in working capital will be treated as an outflows. So it means we have working capital, WC, working capital. So at the beginning of year 1, that amounted to 30,000. The 30,000 you have at the beginning of the year 1 will be treated as an outflow in year 0. So I've told you cash flows occurring at the beginning of the year will be used in the immediate preceding year. So since it occurs at the beginning of year 1, so you have it in year 0. So the one that occurs at the beginning of year 2, you have that in year 1. So as an outflows. So we have 30,000 at the beginning of year 1, you have that in year 0. The 20,000 that occurs at the beginning of year 2, you have that as an outflows in year 1. Then the whole of the working capital, the total working capital you have now is total 50,000. So at the end of the project life, you have the 50,000 treated as an inflows. So you recover it at the end of the project life and then treat that as an inflow. That is the solution to that. Example 4. We are seeing already back cost of investments in working capital. A company is considering a project with a 3-year life. The project will require generate the following sales, and the working capital is expected to be 10% of sales. The sales for the period are as follows. We have sales year 1, 1,250,000, year 2, 2 million, year 3, 1.8 million. Required. What is the working capital to be recognized for the project over the period? You know, the life of the project is 3 years, and you are given the sales for each of the years. So we have years. Let me have workings. Year. We have 3 years involved, year 1, year 2, and 3. You are given sales for each of the years. Sales. Year 1, 1,250,000. Year 2, 2 million. And year 3, you are given a sales of 1.8 million. And you were told that the working capital is 10% of sales. If working capital is 10% of sales, therefore, how much will be the working capital in each of the year? Working capital. 10% of sales. 10% of this will be 1 million. Will be 125,000. This one will be 200,000. And this one will be 180,000. 10% of 1.8 million will be 180,000. So now for investment appraisal purpose, so you could have working capital. Let me say years. Year 3, 2, 1, and year 0. So remember, I've told you that the working capital, I said it will be treated as an outflow in year 0. How much do you have as your initial working capital? You know, in year 1, you have 125,000. We said that will be treated as an outflow in year 0. In year 1, between year 1 and year 2, the working capital has increased by 75,000, being the difference between 125,000 minus 200,000. So you have increase of 75,000. That will be treated as an outflows in year 1. Then, between year 2 and 3, it has reduced from 200,000 to 180,000. A decrease 200,000 minus 180,000, a decrease of 20,000. The decrease in working capital will be treated as an inflows. So we have that as 20,000 inflows in year 2. And at the end of the project life, the whole of the working capital will be recovered. How much do you have as working capital? In year 1, you have 125,000. Your working capital became 200,000 in year 2, and now in year 3, you're having 180,000 as working capital. So that means the overall working capital you have, this plus this minus this, it will be 180,000. So the 180,000 will be recovered and be treated as an inflow at the end of the project life. So that is how that working capital will be treated. Relevant cost of labor. Labor is a human effort used in production. So the reward of labor is wages and salary. So we will categorize labor into 2 for the purpose of our discussion of relevant cost of labor. We have full-time staff, full-time labor, full-time staff, and part-time labor or part-time staff. The full-time labor, they are salary worker. They are salaried workers. So it means whether the project will be undertaken or not, these staff have been employed by the company and their salary will be paid whether or not they work in the project we want to consider. So since their salary will be phased, so the relevant cost of full-time labor is 0. That is, the salary paid to a full-time staff is not relevant. How do you know when the salary is when the labor is full-time? Where spare capacity exists. Spare capacity exists. You know that the labor are full-time. So the relevant cost of these categories of labor is 0. That means it is not relevant. So, but for part-time labor, these are workers that will specifically work in the project in question. That means they will be employed because of the project under consideration. Without the project in question, this staff will not be engaged. We only engage them temporarily to come and assist you in that particular project. So the wages you pay them is a relevant cost. Number 6, we have opportunity costs. Opportunity costs. Opportunity costs are benefits forgone by using assets or resources for one purpose instead of using them in more profitable alternative way. Benefits forgone by using assets or resources for one purpose instead of using them in more profitable alternative way. Opportunity cost may be measured as contribution forgone. It may be measured as contribution forgone. That is, you may measure the opportunity as lost contribution or present value. Present value in discounted cash flows analysis. So these are the 2 ways of measuring the opportunity cost. You may measure it as contribution forgone, or you may measure them as present value in discounted cash flows analysis. When resources are limited in supply, if resources are limited in supply, there are shortage of resources, it is not readily available. If they have more than one alternative use, that is, the resources that are limited in supply can be used in more than one way. You may either use it in this option 1 or you use it for option 2. So that is, you can use it in more than one alternative way. The opportunity cost is the contribution forgone. The contribution forgone by using them for one purpose and not being able to use them for another purpose. So the contribution forgone, where the resources that are limited in supply and they have alternative use, they can be used in more than one option. So their opportunity cost is the lost contribution by having alternative use of that resources. Example 5, opportunity cost. A company is considering investing in a major new information system. The investment will require the use of 6 of company's IT specialists for the first 1 year of the project. These IT specialists are each paid 100,000 naira each per year. IT specialists are difficult to recruit. If the 6 specialists are not used on this project, they will be employed on other projects that will earn a total contribution of 500,000 naira required. Calculate the relevant costs on this investment. So this question is obtained from ICAN study test by Emily Wolf International. Opportunity cost in relevant costs. You were told a company is considering investing in a major new information system. The investment will require the use of 6 of companies' IT specialists for the first 1 year. So this investment will require 6 specialists. It means if the company's own staff are not used in this project, they will need to employ the IT specialists who will do the job. So it means the relevant cost will be labor cost, which is the salary. Relevant costs will comprise its labor cost, because the IT staff will specifically work in this project, and their salary, relevant cost in year one, since it is cost in first 1 year of the project. So salary, 6 staff, and each will be paid the sum of 100,000 naira. So 6 times 100,000 naira, that gives us 600,000 naira. Now, we were told these IT specialists are each paid 100,000 naira each per year. IT specialists are difficult to recruit. They are difficult to recruit. If the 6 specialists are not used on this project, they'll be employed on other projects that will earn a total contribution of 500,000 naira. So because you want to use the specialists, the IT staff, in this project, you will not be able to use those IT staff in the alternative project that will earn them contribution of 500,000 naira. So that means that contribution will be lost. It will not be earned because you can't use them in 2 places. You are using them in this project. You will pay them the salary of 600,000 naira. If you use them in the project, then lost contribution now. Lost contribution from alternative projects, since they will not be able to work in alternative project, and the contribution expected in the alternative project of 500,000 will be lost. So that means the relevant cost will be their salary, that is the labor cost, plus the lost contribution from alternative projects. So you have the relevant cost to be 1.1 million naira. So that is the relevant cost of the IT specialist in year 1. This marks the end of this video. In my next lecture, I will solve a comprehensive question that will involve the calculation of net present value and internal rate of returns, and the question will equally involve the application of relevant costing in identifying those costs that will be considered in the calculation of the net present value. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA.